Hello everyone. The main content of today's video is that I will explain the concept of a fake key level. This term has been mentioned in previous videos on the channel, but in this video, I will explain it more clearly. What a fake key level is through the trades I've executed. But first, I need to clarify that this video is not a beginner level video. It's more advanced than recent videos. But if you watch and understand it, it may address some other questions or doubts you might have. Let's get started. This is the pound sterling to US dollar pair, a familiar trading pair for me. My entry time frame is typically the 15-minute chart. Sometimes I also trade on the 5-minute chart, but the chart you're seeing is a higher time frame than my entry time frame. It's the 1-hour chart. Looking at this, we can see the 1-hour chart is moving sideways. It's in a consolidation phase. It's consolidating like this. So if your entry time frame is the 1-hour chart, you won't see any trading opportunities. But if your entry time frame is the 15-minute or 5-minute chart like mine, there are plenty of trading opportunities in this scenario. For example, here we have a sell opportunity here. Of course, looking at this chart, you might not understand why I was able to place a sell order like this, because this time frame doesn't show it clearly. But if you switch to a lower time frame, like the 15-minute or 5-minute chart, the sell opportunity in this case is extremely clear and ideal. But in this video, I won't discuss how we enter trades when the market is consolidating, because in a previous video, I already mentioned it. But at that time, I felt it wasn't interesting or new, so I deleted it. I didn't edit it anymore. I'll make another video instead. The price continued to move sideways. Later on, the price broke down. I also managed to place a trade here, but this trade wasn't particularly noteworthy, so I'll just demonstrate it manually. That's the trade I entered. After entering, the price continued to drop. It broke through this key level. So I reviewed it again. Switching back to the 1-hour chart. This is where I just took profit. But it broke through here. It broke below this key level. According to theory, the price should return to the origin of the uptrend. The origin of the uptrend is clearly here. This is the starting point of the uptrend. So I looked for sell opportunities. There were plenty of opportunities to sell down to this price zone. Switching back to my entry time frame, the 15-minute chart. The price retraced and then continued to drop. Here is the key support level. This is the previous low. But the question is, it dropped. So what is this price zone, this messy price action here? What is it? Is it a consolidation zone or a retracement? If we only look at this, we definitely conclude it's a consolidation zone, not a retracement. But remember, before we make any conclusions, we shouldn't rely on just one time frame. We need to analyze multiple time frames, at least 2 time frames. So for this price zone, I wanted to verify whether it's consolidation or retracement. I switched to a lower time frame, the 5-minute chart. This is the 5-minute chart. I'll draw the price action. The price retraced, consolidated for 3 candles. Then continued to rise, consolidated, rose again, consolidated, then dropped. So looking at the 5-minute chart, we can confirm this is a retracement, not consolidation. It's quite clear, with many retracement candles like this. So we can confirm. On the 15-minute chart, this zone that looks like consolidation is actually a retracement, not consolidation. This is market noise. If we only look at one time frame, we're likely to make mistakes. But if we analyze multiple time frames at the same time, at the same point, we can see the true nature of that price action. Like this, it retraced and then dropped. So why did it retrace like this, but didn't return to the previous low? As I mentioned in other videos, when the price retraces, it usually returns to a key level or the previous low. So in this case, why didn't it return to the previous low? It's simple. The market is in a strong downtrend. A very strong downtrend. It's evident in what we see. The red candles are long-bodied. Long candles with large bodies. The downward momentum is very strong, while the green candles that retrace up are only weak green candles. They're weak, not strong enough. So we can see the downward momentum is still very strong. That's why when the price retraces like this, it's not a trend. It's just a retracement. So it's likely to retrace only a little, and then drop. There's no reason for it to return to a key level or the previous low. But if it retraces and forms an uptrend, remember, forms an uptrend, then it's very likely it will rise to the previous low or a key level. But if it's just a retracement like a straight line, it's very likely it won't return to the previous low or a key level. The price rises and then drops like this. At that moment, this forms a key level. It represents strong selling pressure here. There's selling pressure here. The price rose but didn't continue and dropped back, so there's selling pressure present here. We simply call it a key level. And when the price returns to this level again, it's very likely to form a double top pattern. A double top pattern in a downtrend means the downtrend will likely continue. At this point, the key level has shifted down here. This is the new key level. And this is the previous low. Why did I draw the previous low so wide? Because this is the previous low. But this area is just a false breakout. Not a true breakout. You can look closer at these breakout candles. It's just a false breakout. I even checked a lower time frame, the 2-minute chart, but in this video, I won't go into such low time frames to avoid causing FOMO. It's a false breakout, so I drew it wider. This is the previous low zone. The price retraced, and I checked Fibonacci levels. The previous low aligns with the Fibonacci 0.5 to 0.618 levels. That's a positive signal. And like in other videos, we could place a sell order here. But at that moment, I decided not to sell in this case, because I had a feeling it wouldn't return to the previous low. I speculated it would return to the key level. Why? It was just a guess. Sometimes I think it will return to this level, so I didn't place a sell order here. And if it only returned to the previous low and dropped, I wouldn't regret it, because I thought it would return here, and if it didn't, fine, I'd let it go. No regrets. And when the price moved like this, it didn't return to the previous low but shot up like this. I felt my speculation was correct. It had to return to the key level in this case. It broke through the previous low. Plus, it formed an uptrend. And the market moved like this. And because it moved like that, this is the key level of that uptrend. Plus, this is the previous high. The price broke above the previous high but didn't go far, so it's certain it will return to the key level. I thought it would return here, so I decided to place an advanced trade. Following the retracement trend, I placed a buy order at the key level. Buying up. Taking profit at the key level of this downtrend. When I placed a trade like this, I thought, if I entered a trade like this, it's similar to other videos, it's nothing new. So I decided not to enter this way anymore. I used a different method. This method I used before, but later abandoned because it involved too many steps. So I stopped. I only used this method, entering just one trade. Back then, I used to apply. Instead of entering one trade like this, with a risk-reward ratio where a loss would cost 2% of the account, I entered 2 trades. If they lost, each trade would only cost 1% of the account, totaling 2% of the account, but I split it into 2 trades. Instead of 1 trade, I entered 2. 1 trade. I set here, taking profit at the previous high. This is a safe take profit, achieving a risk-reward ratio of about 1 to 1.92. The second trade has the same entry and stop loss, but I take profit further at the key level of the downtrend in this case. So why did I enter these two trades? Because there's no guarantee that any trade we enter will hit take profit. It might go up, touch this high, and drop. What then? That's why this trading method, in my opinion, balances a safe approach and a riskier one. But later, I stopped using this method, simply because I felt it was time consuming. Entering two trades and managing them was too time consuming. So later, I only entered one trade. But back then, I used this method and found it very effective. You can try this method. Both trades hit stop loss. I felt my analysis was solid. The price broke the previous low. It should go to the key level and rise. So why did it drop like this? I know many of you feel the same in this situation. You feel your analysis is solid. You enter the trade confidently, but it still hits stop loss. In fact, this trade of mine, hit stop loss immediately. No chance to break even. When we face situations like this, feeling certain that we're right and will win, but lose painfully like this, some people first doubt themselves, and second, doubt the method. Those are just excuses, blaming something. Before we blame anyone, let's review why this trade lost. At that time, I didn't see my mistake. I didn't realize it, but later I did. The mistake in this trade was a basic one for me. I didn't analyze multiple time frames before entering the trade. Let's review. At that moment, I only looked at the 5-minute chart. I drew the previous low like this. But if I switch to a higher time frame, the 15-minute chart, it's clearer. We draw the previous low like this. Isn't that too subjective? Or is drawing it like this more objective? Of course. Drawing it like this is more objective. Drawing it like this is subjective. Switching to the 10-minute chart, it's the same result. But at that time, I only looked at the 5-minute chart. So I drew it down here. While we can see right here, it dropped and immediately wicked up. This is a wick on a higher time frame, but on a lower time frame, too low. Drawing it like this, it should be like this to make sense. In reality, the price is still within this previous low zone. Plus, the previous low aligns with the Fibonacci 0.5 to 0.618 levels. So if I traded based on Fibonacci, I'd place a trade like this. My stop loss is 15 pips. On the 15-minute chart, my stop loss is usually 20 pips. On the 5-minute chart, my stop loss is 15 pips. On the lower time frame, my stop loss is 12 pips. If I placed a trade like this, I'd have won. Of course, we made a mistake. If we're wrong, fine, take it as a lesson for the next trade to learn from. Let's continue to see how the market reacts. The price keeps dropping strongly. So this downtrend, will it continue to drop? Let's review the higher time frame first. It's close to this key level. It will likely drop to this key level. Switching back to the 15-minute chart. At this point, what do we have? Before this, it was an uptrend, a retracement trend. This uptrend reversed and became a downtrend. So we ignore the previous uptrend. We only focus on the current downtrend. So what do we need to do in this current downtrend? The first thing we need to do is find the key level of the downtrend. But clearly, before this was the key level of the downtrend. But at this point, it retraced. The retracement looks quite poor. So is this a retracement or consolidation? If this is just a consolidation zone, then this is still the key level. But if this is a retracement, then the key level in this case has shifted down here. It's moved down here. So which is the key level, here or here? We can't just look at one time frame to make a conclusion. In this case, I call it a poor retracement, not consolidation. A poor retracement could look like consolidation. It could also be a key level, but it's unclear. So I switch to a lower time frame, the 5-minute chart, to check. On the 5-minute chart, the price retraced with one candle, consolidated for a bit, then rose with a green candle, then paused with a spinning top candle, and dropped. The force wasn't too strong. If we look at this to judge, it still doesn't look good, not like a retracement. It's still poor. In this case, this could be a key level, or it might not be a key level. It's 50-50, not clear, not ideal. And usually, when we encounter unclear situations, we either shouldn't trade, or if we insist on trading in such poor setups like this, we must have a backup plan. At that moment, I had the following issues. First, I measured Fibonacci. The key level was poor, but aligned with the Fibonacci zone from 0.5 to 0.618. That's a positive signal. Plus, this previous low aligns with this. This is a coincidence. Now, let's pause this chart and move to the theory part. I'll talk about the fake key level. This is a simple chart of a downtrend. Looking at this is the key level. And this is the previous low. So what is this key level? It's the fake key level. Back then, I got confused. I thought this was the key level. So I often placed sell orders at this key level. Sometimes I won, sometimes I lost. But when I lost, I noted it and reviewed. The price rose, touched the key level up here, and then dropped. So this key level is not the key level. But back then, I mistook it for the key level. So I called it a fake key level. Meaning a fake version of the key level, not the actual key level. If I named it now, I'd call it a secondary key level. It sounds better. But since I'm used to it, and have called it that, I'll stick with fake key level. So in reality, how does the market usually move? Based on my experience, the price often retraces to this previous low. The candle wick touches the fake key level likely, and the price drops. This scenario happens about 60% to 70% of the time. The remaining 30% is when it reaches the key level and drops. So let's return to this chart. Although this case isn't exactly like the scenario I just drew, because this segment is an uptrend, not just a directional move like the chart I drew. But there's a coincidence like this. And so at that moment, although this retracement wasn't ideal, I still decided to place a sell order right at this key level, which might be fake, or might be the key level. I still decided to place a sell order here. The stop loss was 15 pips. One trade takes profit here, a safe take profit. The second trade, I take profit at the zone I plan to take profit from the start. The risk-reward ratio is 1 to 6.4. And when we enter trades, in cases that aren't very clear like this, we need to have a backup plan. My backup plan was, I had prepared mentally. My mindset was that this trade might very well be wrong. If it loses, I'd enter another trade right at the key level here. If these two trades lose, I'd enter two more trades. And that's my backup plan. Finally, the price hit take profit. Goodbye, see you all in the next videos.